Welcome back. We're going to take a side step today, talk about stock market indices and the difference between these indices, what it can tell us. The most popular indices are the Dow Jones Industrial Average. Now that's a collection of the 30 largest stocks listed that represents the U.S. economy. We're talking about names like American Express, Boeing, Home Depot, Coca-Cola, Walmart, McDonald's, things of that nature. The S&P 500 is a list of 500 companies with the largest market capitalization. It's a much more representative list. The NASDAQ is an index comprised of stocks listed on the NASDAQ exchange. It's got over 2,500 stocks. It's heavily weighted towards technology, healthcare, biotech, things of that nature. And then we have the Russell 2000, which is a small cap market index. It's made up of the smallest 2,000 stocks, comprised of companies in various sectors, but mostly towards the technology and biotech area. Now, what we're going to look at is a ranking of each index in order to measure them all on an equal basis. Now, they're ranked based on their daily closing price in relation to each indice's respective year's trading range. So we take a look at the entire year's worth trading, and then we say, okay, where does it rank? Where's today's close rank within that yearly range? We're going to calculate the spread. Now, the spread is a difference in the rankings, meaning if all the indices are ranked number one, meaning they're all at the 52-week high for the year, they'll all be trading very, very close together, and the spread will be very close. However, if we have one index that's at its 52-week high and another index that's very, very low, we're going to see a wider spread. So let's go back in history and see what this looks like. This is the year 2000, starting June, when we just after hitting those all-time highs. Now, the blue line represents the Dow Jones Industrial Average. The purple line at the top represents the S&P 500. The black line is the NASDAQ, and the red line is the Russell 2000. Now, here's the point. When the market was hitting very significant highs, all the stocks were going up and hitting all highs at the same time. Like the expression, a rising tide lifts all boats. It really wasn't very specific in terms of which stocks. You could have bought virtually any stock and made money. Everything was going up. And we can see this with a very tight grouping, where that all the stocks, each one of their respective ranks, was very close to number one. We can see the scale on the left-hand side, 0 or 1, meaning number one ranking for the year. Now, when the market started to turn down, we remember this was a technology boom. And when the market went down, it was the technology stocks that went down first and went down hardest. Now, the black line represents the NASDAQ, which, remember, is heavily weighted towards technology. That's why the black line went down so much more than, for example, the blue line, which is the Dow Jones Industrial Average. Now, of course, American Express and Boeing, those companies, they go down, but not nearly to the same extent as those technology stocks like Yahoo, for example. Now, same period of time, this is 2000 to 3. And this black histogram bar in the background shows us the spread. Remember, that's the difference between the different indices. The blue line represents the Dow Jones Industrial Average, just to give us an idea about where the market was at that period of time. Now, take a notice, August 2000, when the market was still very close to the highs, we see the spread was relatively low. However, when the NASDAQ stocks started to go down, the spread widened, and we see this with the black histogram bars going up. See, the black histogram bars going up show us that one index, in this case, the NASDAQ stocks were collapsing a lot faster than the others. Now, when the market hit those very significant lows, September, October 2001, all the indices went down, and they all were basically following the same sheet of music, and that's why the spread was very low. But when we started to see eventually a recovery, not all indices moved the same way. Fast forward to 2008. Now, first off, 2007, we know again the stock market was very strong. October 2007, all the lines were very close to the top. The blue is the Dow, the red is the S&P 500, the green line is the NASDAQ, and the black is the Russell. all the stocks were going up. And that really is, a lesson to take away from this. When the market's very, very strong, stocks go up indiscriminately. It doesn't matter what we buy, they all go up. But that's actually a sign that if it's so easy to make money, maybe that's a sign that we're close to the end. Now, when the market went down, it wasn't the NASDAQ stocks, remember, that this time went down in the year 2007. It was the Russell 2000, which are the small cap stocks. Those small cap stocks, a lot of those invested in housing developments and things of that nature, and also, of course, technology. Those went down for the most. What was the most resilient? The NASDAQ, the green line. That didn't go down as much. The NASDAQ stocks, of course, like every other stock, went down in 2007, 2008. But not nearly to the same extent are those stocks, the small banking stocks and the small, home builder stocks. This shows us the spread, the black histogram bar. In the year 2000, when the market was very close to its highs, we see the spread was very, very low. However, when the market started to crumble, all of a sudden, we know that the Russell 2000 collapsed a lot faster than anyone else. Eventually, it hit those huge lows in March of 2009. All the indices went down and hit those huge lows together. But when the market started to recover in 2009, 2010, not all stocks moved the same way. And there's an expression that, the yesterday's leaders will not be tomorrow's leaders, meaning that in the year 2000, it was the NASDAQ stocks that went down, but the new rally was led by new leaders. In 2008, the crash were banking stocks and housing stocks. Of course, they did bounce back, but the new rally was led by new leaders. This is the 2019 now ranking. We hit those very significant highs. Look how close all the lines were. The yellow is a Russell, the black is the Dow, the purple is the NASDAQ, and the orange is the S&P 500. Now, in this case, again, the Russell 2000, the small cap stocks really got clobbered in 2018. Not as much, for example, as the orange line, the S&P 500, the black line of the Dow Jones Industrial Average. Take a look at the spread. Again, the spread was very low in 2018, early 2018, mid 2018. But when the market started to crumble, all of a sudden the indices pulled away from each other. See, when the market is moving in unison all together, and especially when we hit those very significant highs, all the stocks are marching to the same tune. But when the market starts to make a turn, not all stocks turn together. And I think that's really one of the signals we want to look for, is that if the spread is very, very low, all the stocks are moving together. And we don't have to watch a spread, to calculate this on a daily basis. But we can very simply make a note. Are all the stocks, or the vast majority of the stocks, hitting a significant high or a significant low? Or is it a more equal distribution? A more equal distribution, I think, is a much healthier type of market. But when we see all the stocks moving up and hitting new 52-week highs or hitting 52-week lows, that shows us the market's probably hit an extreme. Now, fast forward to present day. We see at the top of the list, the red Dow Jones Industrial Average. Again, that's Boeing, McDonald's, American Express, companies of that nature. Number 2, S&P 500. The 500 biggest stocks, heavily weighted towards technology, biotech, things of that nature. The NASDAQ is up there in those levels as well. Take a look what's happening, though. The Russell 2000, the orange line, is far, far below the rest of the stocks. And, we could interpret this a couple different ways, but it really does show us that the economy is divided, that the economy maybe is favoring the bigger companies out there, or better yet, the bigger companies out there are able to withstand the headwinds that we see right now. Employment issues, very high inflation, things of that nature. The smaller companies are not faring well. And usually, the small companies, meaning the orange line, the Russell 2000, that acts in a sense as a canary in the coal mines, meaning that when the economy is very strong, small companies do well. It's a very favorable environment for small companies to flourish and to become big companies. But when things are tough, it's the small companies that get hurt the worst and hurt the first, so to speak. So if the Russell 2000 is not participating in this market, well, I think that probably tells us something. Again, we go back to, the year 2000. Things were looking very, very good. September, I should say actually July, August 2000. But then the NASDAQ started to fall apart. We go to 2008. And we see here, things are doing so well, but then the Russell started to really falter. And, notice even before in 2007, the Russell 2000 was not performing very well, not compared to the other indices. So I think the takeaway from this is that, the market, for lately it does look strong, but it is a divided market. And the Russell, the small companies are not participating in this rally. We want to see if we're a bull, if we're optimistic on the markets and optimistic on the economy, then the small cap stocks are where we want to look, because we would expect those to catch up to the bigger companies. But conversely, if we look at the horizon and we say, well, maybe there's trouble out there, then we look for the small cap stocks, the Russell 2000, to stay low, and then maybe some of these other indices like the Nasdaq, S&P, or the Dow, to reverse course back to the downside. But we're going to continue to watch this indicator like many others on a very regular basis, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.